Hey guys, very challenging week for trading weekly options. Most of the gains, huge gains that were made on Tuesday and Wednesday, unfortunately were given back on Wednesday and Thursday. Now, very tough trading environment, and I'm going to give you very reasons how to protect yourself from situations like what happened over the last few days here. Big warning, if you are a bear, this video contains some very brutal content that may give you a heart attack. So watch at your own risk. In the previous video posted on Sunday, January the 20th, we made a case how temporary the markets were going to make a pullback, and we specifically pointed out it was literally going to be a pullback, not a crash. To refresh your memory, okay, and before I do this, I just want to say this. It simply does not pay well to be a bear when bulls take over. Just keep that in mind as we're going for this. To review briefly what was discussed in the previous video, right? We showed you a chart of S&P 500 in 1990. Year 1990, and it pretty much looked identical to the chart of S&P 500 in November and December 2018. The similarities that were discovered were divergences on the RSI, the death cross, followed by the bottom. Yes, I did say the bottom because anywhere on the news, the majority of the people still talking about us revisiting these low levels established in December 24th. I will give you plenty of evidence that this is actually not going to take place by showing you some numerous historic examples and describing the conditions that are actually taking over the marketplace right now. What made us look at the 1990 again was similar things in the VIX, similar patterns even in the death cross. And I want you to pay close attention right now as we'll review this part right here. This part right here, meaning when S&P 500 actually broke above the blue line. Okay, so let's go and take a closer look. After it broke the blue line, I want you to pay very close attention to this part, right, where the market looked like it was dropping. So generally the bears would get excited as we had a huge drop on Tuesday. Lots of money made for some of our alert subscribers that were placing bearish bets. Now, things just completely turned around midweek. This is exactly what happened, as you can see portrayed by these black candles right here. These black, tiny little candles actually show you that every time the market would drop, in 1990, the institutional investors, they were coming in and buying the dips. So there was a point on Wednesday this week when the market looked like they were crashing, they were dropping. So we had multiple confirmations that the market was going to drop lower. But what happened is exactly the opposite. The bulls actually stopped the drop. They came in, they bought the dip. As you can see in 1990, the market went, it looked like it was going lower, but all it was really doing, it was going sideways. Very important to observe. Look what happens next. Huge white candle after about a week of sideways trend, and the market breaks out. And where does it go? Close to this orange line. Let's see exactly where would that put us in relation to the current conditions. The most important thing before I go to the next slide is to pay attention to this, that S&P 500 right here, after it broke above the blue line, it actually never breaks below the blue line. Pay very close attention to this, because as the general view is still out there in the media that we will revisit the lows, okay? We're actually not going to revisit the lows. And it's very important to understand, because if you're a hardcore bear, it is going to be very difficult for you to stay away from buying puts as the market is doing this. It looks like it's dropping, but it's really not dropping. It's just grinding its way higher in a very weird kind of way, to where if you're just paying attention to the price action, it's really different to differentiate what's a side trend. Is the market crash, or is it really going higher? So if you see this picture, just remember this right here. This is what's about to happen. I'm going to show you exactly why. Again, why did we take a look at the 1990 time frame? Because the VIX, it numerically was close to the 36, and the charts resemble similar pattern and the similar bullish divergence on RSI, death cross before the actual bottom. Again, I'm zooming in a little bit closer. You guys can see. Look at these tiny candles. Those tails of the candles are sticking to the bottom, and that tells you that basically at times the market would open lower, as we can easily get, you know, on Monday and Tuesday the following week, which would be, you know, I guess the 28th and the 29th, right? If you take a look at the formation of these candles, right, they're bullish reversal candles. In other words, something drops, they come in, they buy the dip. This is a bullish reversal type candle. You can see where that ultimately takes the market to. Takes the market higher, not lower. That's observation number one. That's super important. Let's compare it to what's actually been taking place this week on January, 22nd through 25th. Look at the formation of these candles right here. And what a coincidence. The most important observation was made. The market in 1990 actually never drops below the blue line. Look, every time the market dropped this week, what happened? They've come in and they've picked it up right off the blue line and maintained it above the blue line. And look at the formation of these candles. Look at that. It's identical to the candles that we're observing. Now, these are back to back. In the 1990, they were separated by just a couple of candles that were basically just a sideways trend. This is what this means. Big banks, institutional investors are buying the dips despite of all the negative headlines. Guys, I know it's hard to believe, and as a bear, you're thinking, Jesus, possible war with Russia could be sparked by conflict in Venezuela. Market says, no problem, forget about it, we don't even care. Longest government shutdown in history, pointing to a high probability of a lower GDP when it's going to be announced. Market says, hell with it, no problem. German recession is apparent even to a 5-year-old right now. What does the market say? No problem. China slowed down and possible recession in China? We don't care. No problem. Let's just keep buying the dips. And so the main situation is you may be looking at the market, you're thinking, Jesus, there's just so many freaking reasons for this market to drop. And when it starts dropping, you're like, oh yeah, I know, here it is, it's coming. I knew I was right. And guess what happens? They'll come in, they'll buy the dip. All it does, it just gets you highly frustrated, and unfortunately, it doesn't make you any money. But at the end of this video, we're going to give you some practical recommendations how to make the best of these market conditions, okay? So there was one time in recent history that would have similar market conditions and behavior. And let me show you a chart. Does this look familiar? January 2018. Yeah, exactly a year ago, right? Look at this. Jeez, the market just kept going higher and higher and higher, and you maybe think, well, yeah, but you know, they were talking about the lower index. And look, there was actually plenty of other negative things going on, but guess what? It didn't stop the market from going higher. The market just did not care, period, what was going on. It just kept going higher and higher and higher and higher. And then if you're a bear and you're like, whoa, Leonardo, thank you for showing me this because I see what happens next. We crash. And that's exactly what I'm betting on, Leonardo, is we're going to go down. We're going to revisit those lows in December, and that's how I'm going to get my money back, and that's how I'm going to beat the market, and that's how I'm going to make the money. Guys, this is exactly why you don't want to expect, because the probability of this happening in February is next to nothing. I don't want to say it's zero, but guys, it's like 99% that this is not what's going to be taking place in the February of this year. I'm going to show you some charts that's going to bring some light to this picture. But the reason I'm showing you this is there are times in the market, no matter what happens, no matter how negative things could be, okay, it's just going to keep going higher. So oftentimes, it's not the news that we have to be paying attention to. Not all the headlines that are being discussed in the news. We have to really be paying attention. How do institutional investors react to all the events that are unfolding? Two things that caused this actually drop that I was showing you on this previous chart in February 2018. It's important to understand that because that is why we're calculating the probability of a February drop is just pretty much non-existent. So the reason the markets dropped in 2018, February 2nd, February 9th specifically, that first drop was because of the fear of escalating rates. All of a sudden the yields jumped and institutional investors started getting really concerned. It's not the fact that the rates were rising. Everybody knew the rates were going to rise, but the rate of change in the yields is what got everybody to panic. That is when the VIX rocketed all the way to 55. And some people that were just used on selling puts on the VIX, they actually completely blew up, went bankrupt, went out of business. Okay, so that is the environment that we're looking at. And the main reason why the initial drop in February 2018 actually took place was because of the fear of escalating rates. The second drop that actually caused us to revisit the lows in February 2018 was because of the trade war with China. Okay, so there were two major things going on. Are we going to drop in February again? And the answer is no, not this time. So this chart illustrates we're looking at Dow Jones. Okay, so this is where the glorious January, and it's got to repeat. So it's easy to think, okay, if we compare January last year to January this year, shouldn't we automatically expect the February to repeat itself? And so what I'm trying to say here is the answer is clearly no, because we have totally different market conditions. The only conditions are similar that the market just doesn't care, like it did not care in January last year. But I think ultimately in February, we're going to have actually a really nice up month opposed to a down month. So the condition one, again, was the rates were escalating. Condition two for the drop was the trade war. Now, if you look in the history, right, before I start talking about the VIX, when you look at the tariffs that were placed throughout the history of the United States, there's actually no tariff that really survived for over 2 years. And if you look into how far into negotiations both the United States and China has gotten into, and the fact that Trump is already backing down on some of the things that he was threatening, the percentages on tariffs and so on, just tells us that, look, this thing is about to unwind. And if it is a positive, I think the VIX is already telling us the real story that we're about to find out is the fact that there's almost going to be no tariffs. And the resolution is coming soon. Now, it may be coming soon, even though they keep saying it's complicated, it's this, it's that. Guys, Trump wants to be reelected. He needs some positive news. He needs the market to go higher. And if he's not going to start taking action, which he clearly showed today by officially, at least temporarily, ending the government shutdown, he's shown us that he is ready to take action because he needs the votes. So expect good things for the market, at least over the course of the next 6 months. Here's the VIX telling us the divergence. The red dot right here represents the VIX of 55. Now, I know on the chart it only says 50. It actually went to 55 pre-market when we were trading the week of February 2nd, February 9th, 2018. Look where the RSI was. It was basically over 70. You can clearly see that. It's actually a little bit green right here. Now the VIX in December 24th was what? It was at 36. Now the market actually dropped below the level that we experienced in February 2nd through February 9th. What does that tell you? This actually tells you right here. And guys, please, if you don't understand how this works, right? I'm trying to make this video short, but I'm always feel like I'm running out of time to tell you everything I would like to. So if you would like to know what in detail and how to calculate this, I mean, you can certainly take the chart course, just click the link below, understand what these divergences are. Now, fortunately, there's not like 100 cases of divergences. There's only 6 of them on the chart course. If you understand them, you're going to do significantly better than what you're doing right now, I promise you. Vix Divergence. This is the 2 highs that were set on the VIX. We're getting the divergence. A very important thing to understand is this, after the VIX fell, it went sideways for a while, basically for the remainder of most of the 2018, I knew we got a spike in October. What I'm trying to draw here is the fact that now the VIX is going to go sideways. When VIX is going sideways, you don't want to be buying puts. Now, clearly, if you know, let's say, if some biotech company that failed the FDA approval and, you know, the trial results weren't good, that stock is going to flop no matter what. We're talking about general direction, the correlation between typically commonly traded stocks like, you know, Amazon and Google and, you know, Nvidia and so on. Generally, when the market moves higher, they will move higher as well. We're not talking about individual cases of stocks that could be shorted, and you could be certainly buying puts on those if you have your calculations done right. But we're talking about the general direction of the market here predominantly, right? So this was in February 2018. This was in December 24th. Okay, because the market could have actually went lower, we should have had the VIX spike above this level is the main point here, but it did not. And it also failed on the RSI level as well. So that basically tells us the market is going higher from here. And again, if you don't understand what this means or how to interpret this, take the chart course, give you all the details on that. When you have tech stocks doing this, guys, please pay very close attention. It's super important to understand this if you want to make money next week, next few weeks, okay? It's not a bear. Look, when you got stocks like Twilio, okay, I'll show you a chart in a second. XLNX, Netflix, Nvidia, LRCX, take a look at what they're doing. If you understand what this is, you will understand that this is not a bear, because bear markets do not act like this, okay? So here's Twilio, all-time highs. Okay, check this out. This thing right here, even when the markets were crashing, it barely dropped just under the blue line. It's a technology company. When you have technology companies trading at all-time highs, that is not a sign of a bear crash coming that's going to revisit the lows of December 24th. Now, if it was just like one stock, I can understand. You could say, well, this is just one exception, but it is not. Look at this. Look at this XLNX sticker. Jesus. I mean, are you seeing the volume on this? Am I the only one seeing this? I mean, please tell me you're seeing this huge volume. This is actually the highest volume on this freaking chart. Look, the stock breaks out from 88 to 110 bucks over the course of the 2 days. Now, what is the importance of this? You could say, okay, well, occasionally, I mean, you can get lucky with an earnings report. No, the issue is this, and it's not an issue. It's an issue for the bears. Now we have a company that actually reports great earnings, and what happens? They actually buy it. Now, what we've had for the entire duration of 2018, when a company reported great earnings, what did you see? Well, you saw this. This was actually a good report, right? I mean, it dropped. So no matter what the companies were reporting in 2018, even if they were beating earnings expectations, the companies were falling on good earnings. This is actually a confirmation that now if the earnings report is good, they're buying. I mean, did you see IBM finally go higher? I mean, how many times did it have a poor report and it dropped? And this time, it went higher. So I can give you instances and instances of this situation. I mean, Netflix, look at this. After a tiny dip after earnings. Now, the earnings were actually not good, but they were interpreted as good earnings. I mean, Netflix actually missed the numbers. And generally speaking, if you look for the history of Netflix, when it misses the numbers, the stock tanks. But not this time. I mean, this is not a tank, Jesus. When you look in the context, right, it's up 130 bucks in 2-3 weeks. It makes this tiny pullback to the support level. I'm not sure if you watched the video we posted on Netflix, but we said, look, the probability of a huge sell-off is unlikely. We said they're going to come in and buy the dip. Okay, and that's exactly what they've been doing. They basically dropped the stock to 320, 330. They've come in, they're buying the dip. Look where the stock ended today. I honestly thought it was going to go above 340 today, but it stalled out around 339 level. But look the importance of this level. It closed above the orange line. So they're coming in, they're buying the stock on bad earnings. They interpreted them as good earnings, and I guarantee you with a 90% probability that Netflix shares will go higher next week. Now, I mean, I know it's kind of hard to believe it after a 130 point run, right? They're buying it just $10, $20 under after the earnings. I mean, this is crazy. On what appears to be a bad earnings report. Like, check out Nvidia, okay? You may be thinking, okay, Nvidia, you mean Nvidia is bullish too? Look, it's strong above the blue, meaning above the blue line. Look at the volume. Guys, this is not a joke, right? You had the strongest sell volume right here. Now the investors are coming in, they're scooping up the stock, and the importance is this. Look at these line that they drew right here. The accumulation volume is actually going higher. Look at the biggest day. So the banks, institutional investors, meaning they're back to doing their regular thing. What is the regular thing they do? They typically, when something breaks above the blue line, that is an indication that they want to buy, and they want to buy more. And this is the first time we're observing this in semiconductor stocks in a long time. Now look at the volume today. So yesterday, for the first time, of course, LRCX, Lam Research reported great results. The stock got bought, went higher. All the semiconductor stocks went higher along with it. And then the crazy thing is, yesterday Intel reported really bad earnings, missed on everything, right? And initially dropped quite a bit, but made a sort of a bit of a comeback. Didn't close at the lows. But look, with Intel earnings like this, that should definitely impact Nvidia. And so it was dropping per minute. Look where it closed. And look at what kind of volume. So it makes another high above the blue. They're buying it. 160. And this thing can easily close this gap in the next couple of months. We could see it back to the 180, 190 level. Okay, moving on. So LRCX is what sort of got this rally going on in all semiconductor stocks. And I'll be honest with you, I was watching all these semiconductor stocks going higher yesterday. And there was just one thing that I could not understand. was, okay, if all these chip makers are going higher, why is Apple not going higher? And that's what sort of for the duration of the day was causing me not to get bullish, because Apple was just not reacting. But guess what we got today? Friday, January the 25th, Apple started rocketing higher on huge volume into the close. So now we've got the big picture. We got the semis, we got the component makers for all these iPhones and all, all that stuff that's being made these days in the technology sector. They're going higher. Apple is going higher. We got the big picture. The money is going in, not out of these things. LRCX is a good example when a frog turns into a princess in 48 hours from $135 to $165. This is how it looks on the chart. Pretty freaking amazing. Okay, not only this, all right, check this out. Guys, this is like a historic case book example out of the crash in 1987. For those of you that may have not studied the crash of 1987, one of the reasons the huge drop was prevented because companies started buying their own stocks. Now, the main difference, of course, in the 1980s, we had interest rates that were like crazy higher than what they are right now. I mean, interest rates in the 1980s, they were like, 15, 18%. So if somebody wanted to do a buyback, they'd have to borrow money at 15% to do it. Now, this is not the case now. So the rates are, historically speaking, they're pretty much at, all historic lows still. $21 billion company, LRCX, Lam Research, decides to do a $5 billion buyback, right? When you look at these numbers, decides to buy a quarter of its shares back. I mean, come on. Clearly, this thing is not going to drop, okay? I mean, and the most important and relevant observation of this is the companies were not in the 1980s with the high rates. One of the main reasons for companies, and certainly is a great incentive, to buy their shares back by borrowing money at low interest rates. So what we're saying is there's going to be a huge amount of buybacks that will stop the market from going lower. So the case of visiting the lows that were created in December, they have a minimum probability, okay? So lower rate environment actually creates more buybacks, not less buybacks. So the next question you may be saying, well, what makes you think that they're not going to raise the rates? Well, we've said in multiple videos posted back in September that there's going to be no more rate hikes. They actually may be coming out with stimulus, and certainly the unwinding of the balance is going to slow down. So here's what we got. How do we know that the rates are not going higher? Well, here's a nice little chart of gold from 1980, which was here. But look at the beginning of the chart. The beginning of the chart is right here, October 74. That is where actually after falling, gold starts taking off. It goes from 100 to 150. Yes, it does coincide with when the United States went of gold standard, and it was shortly after that, and so on. So gold was drastically rising in relation to a dollar. Similar conditions, as you probably heard in the 70s, in this country we had a big oil crisis, so dollar was depreciating in relation to the value of oil. Now, what do we have now that would make me look at this time frame of 1974? Well, dollar losing its value in relation to gold and oil once again, but not other currencies. So the interesting thing in the 70s was the fact that even dollar was falling in relation to gold and oil. It was not falling in relation to other currencies, which is exactly what we have right now. That is why I wanted to go and examine the charts of 1973, 74, 75 to get a better clue of what's actually going to be happening here in the near term. Now, this is what's happening to gold, and you started probably, if you've been watching our videos, we said in September and October that gold was going to move higher. We put a really good-sized video talking right here at the 1230s, 1240s level that gold was going to move substantially higher. We actually have predicted back then in November, October, November, that gold was going to form this bullish crossover. Now, if you watched a lot of our videos, a lot of times we talk about the bearish crossovers, and which is exactly the reverse of that when the blue line crosses the orange line on the way down. Now, in gold, we have exactly the opposite taking place. The 50-day is crossing the 200-day moving average, and that is generally a bullish thing. The most important observation in this chart is this, guys. Do you see this huge white candle? Probably all over the news they're talking today that gold is, man, look at gold today. Like, what a move. Oh my God. Now, there's nothing wrong with gold moving 18 bucks. However, this is something that is wrong, or not necessarily wrong, but it is something that to be paying attention to, because next week we have Federal Reserve announcements. Generally speaking, you would not see a huge move in gold like this unless you know for a fact that Federal Reserve is not going to be raising interest rates. Now, not only do we observe this bullish action in gold, but we're also observing this bullish action in oil, right? So oil, look, above the blues, nice and strong, just like in the chart of 1990 of S&P 500, breaks above the blue, hence nice and strong. Look at these candles that are being created right there. These are bullish reversal candles. That makes us think that gold can go back. Yeah, it can go back right here to 64 in the near term. Not like next week, clearly, but generally is going to be moving higher from here. So we got rising gold, rising oil, very similar to the situation in 1974. So maybe we should consider in looking at the charts in 1974. But before we do that, let me address this probably objection that you got in your mind. Is you may be saying, you may be thinking this, well, this is highly contradictory because the rates just kept soaring throughout the 70s and the 80s to combat inflation. And yes, you are 100% right. But at the same time, we did not have a $22 trillion debt. Simply put, we cannot afford right now to have interest rates going any higher from where we got them. Otherwise, we could see the whole bubble pop. Trump is just simply not going to let that happen. That's why he has been attacking the Federal Reserve so vividly over the course of the last 6 months, telling them that he's going to fire the Fed chief and all this crazy stuff, okay? But clearly, he knows what would this do to the country and its inability to service this $22 trillion debt at higher interest rates. So we have a combination of a crazy situation where we have commodity prices going higher, telling us that the interest rate hikes are greatly unlikely. Okay, we have the Fed that now has been raising interest rates for the last few years. This has been one of the longest interest rate cycles in the history. And so the probability is this, and as such, that Federal Reserve will put the rate hikes on hold. And if that takes place, okay, we will clearly see that companies will come out and they will buy the hell out of their own stock, which is why the market is not going to fall. Now, I'm going to show you a series of charts dated to October 1974 and just going about a year out from there, so you could see historically what could happen in such environment. And in just a few moments, I'm also going to show you a conclusion of what happens on the charts when Federal Reserve stops hiking rates after hiking them for a number of years. So here's chart number one. This is Dow Jones in 1974. And if you look at this chart resembles highly what was taking place in October, in December in 2018. So we have the death cross, we got the huge drop. Very similar, right? That's actually the same chart I got here. A 1974 crash. S&P 500, so October, right, similar, so S&P, Dow Jones, and October 74 resemble the charts that we were observing in October, November, December 2018. I mean, if you measure them, the time frames on these drops and the crosses and some of the other indicators, they're basically identical. Does this chart look familiar? Okay, so this is actually S&P 500, combines a little longer time frame here, boom, boom, but you get the idea, right? The crash. Boom, if you were to switch August and September and October for October, November, and December, you would basically get 2019 right here on the chart. Looks identical. So, and here's actually the chart on December 24, 2019. So do you see the death cross? Do you see the drop? Okay, hopefully you get the idea of the similarities here because we're going to use them to try to identify what happens next. So January 1975. Look what happens. So we hit the low, we hit the second low, we start bouncing. That's fast forward. That's the bounce on Dow Jones, resembles the S&P. So I've got basically some charts here of S&P 500 dated 1974-75 and Dow Jones 74-75 as well. Basically, they're pretty much identical, right? Actually, Dow Jones resembles the current chart even a little bit better than the S&P 500, right? You got the low followed by a lower low, and after that you got the bounce. Strong accumulation, really good indication, really good, lots of bullish stuff going on. Now, this is January 16, 2019. This is about the time that we're getting to the breaking above that blue line, okay? So very similar conditions. If we fast forward just a little bit, of course, the question is what's next? Well, in 1975, look what happens next. We break above the blue line. Dow Jones in 1975 would just break just a tiny bit above the blue line. Then what happens if we fast forward, right? April 1975, notice after we broke above the blue line, we keep going sideways to higher. Very important, guys. Please pay attention right here, because if you understand this, you're going to do really well in the next couple of months here. Now, in the meantime, look, there are days where S&P 500 drops, but look what you get. Look at the formation of this candle, similar to the formation of the candles in the 1990, similar to the formations that we're experiencing in the candles right now this week. This is a bullish reversal candle with its tail sticking out all the way where? Coincidentally, the blue line. That's exactly what we have right now. And what happens after that? Sideways trend, but it never breaks below the blue line. Remember, we discussed that earlier when we were looking at the charts of the 1990s. It never breaks below the blue line. Okay, Dow Jones, look at the same thing. Goes right here, makes a pullback. Intraday breaks below the blue line, but sharply bounces off of it and goes significantly higher after that. Sideways to higher. July. This is why I kept saying in some prior videos, I've been observing this, I didn't want to get everybody confused. We've seen the market's going to go down, the market's going to go higher. So basically short term, when I posted the video on January 20th, I said, yes, short term pullback followed by a long term bounce in the market. So again, I'm not saying this is what's going to happen next week. We could easily get some pullbacks like this next week to where we're going sideways. But the most important thing, if you're trying to figure out what is going to go on with the market overall, this will take us basically to July. If I correctly identify the market environment, then some of the things, even though they may sound a bit contradictory to some of you, but I think this is exactly what's going to take place. July 16th, 1975 looks like this. The importance of this is the area where we're basically hitting this orange line. Considering some of the action in the markets right here, we may be hitting some orange line levels on S&P and Dow Jones much faster than July. Okay, but the idea is this: going sideways to higher has got the highest probability right now. And again, this is not just confirmed on the 1990 chart. Now we're looking at the 1974. As you can see, no break below the blue line, sideways to uptrend. Okay, Dow Jones, similar thing. Look, once it breaks above the blue line, sideways to uptrend, actually breaks a little bit above the 200-day moving average at that point in time. October. So this is once we get to July, and on S&P 500 in 1975, we actually failed to break above the 200-day moving average. We actually get a pretty significant pullback, but notice again, we don't break below the blue line. So this is what's going to happen. We're going sideways to higher. Then somewhere around July, we may have a pullback right here. This is what I think is going to happen with the markets here in the United States in 2019. So Dow Jones, same thing. Look, after it just briefly breaks above that, and look at the formation of these candles. See, now the tails are sticking up there, the tiny part, we call it the failed rocket launch. And so once the rocket is launched, it comes right back. The launch has failed. It's not moving to the moon. It comes back to Earth. You see, you got 1, 2, 3, 4 of these candle formations right here. What happens next? The market drops. Not drops like crazy. Again, we're not talking about the crash. And look at this point. We're certainly way off of these December lows. And yeah, if you look at this chart right here, look how cool this is. This is 1975, guys, but the chart, if you pull up identical on stockcharts.com right now, right? Here's your def cross. Here's the first leg lower. Here's the second one, which is lower. The RSI divergence is right here. So everything pretty much matches as far as the chart pattern, as far as the def cross, as far as the divergence on the RSI, as far as, everything is here. So I think there's a high probability this is exactly what we're going to see. The most important observations, again, is we're not going to drop below the blue line now. We're going to go all the way to the 200-day moving average or above before we make the next pullback. So don't be a bear, be a bull. The most important observations of all, and if you're a bear and you've still watched the video till now, I strongly advise you to pause, go do something else. Do not watch this part, guys. Seriously, if you're a hardcore bear, you do not want to see this. What happens after long hiking cycles when Federal Reserve stops raising rates? There's actually two intervals in the history of the United States market and the Fed when the Fed, after keep raising rates for multiple years, stops. One of them is a time frame in 1995, and here's a chart of Dow Jones. So it ends raising rates right here, and look what happens next. So rate hike cycle ends. Look what happens to the market. Pretty crazy stuff. Okay, 1995 S&P 500. Rate cycle ends. Look what happens next. Okay, if this is not enough, there's another time frame in the history of the markets and the Fed where after consecutively raising interest rates for a long time, the Federal Reserve stops, and this is what happens in 2006. Rate hike cycle ends. This is a picture of Dow Jones. Look what happens next. Whew. To the moon. 2006 S&P 500, same thing. Rate hike cycle ends. To the moon. Notice how close this is to the 2008, right? So this was 06. The market keeps going 07, 08. We have the huge drop in 08, 09, right? We are not far from the drop. What I'm saying is just we're far from the drop short term because the market could go substantially higher by July before we even going to have some significant pullbacks. What you ideally want to understand is the key takeaways. And I think what I have forgotten to insert here is the picture of VIX that was going to show you what happens to the VIX next. And basically, the VIX is coming out of a high numerical value into a lower value. We say that the VIX is going to go lower from here. It is downtrending after failing a key level of around 21.9. Couldn't sustain that level. For a minute there, it looked like it was going to be an uptrend again, but it reversed. Today, VIX is around 17. It's in the 17 range. So the downtrend in the VIX was actually confirmed. So key takeaways. Bulls are in control, buying every dip. 80-90% probability of moving sideways to higher in the next 3 to 6 months. Pullbacks are to be expected, as shown in the charts of 1990, as shown in the charts of 1974, 75. Pullbacks are to be expected. They are normal. But they are to be bought rather than shorted. Number 4, there will be no revisit of December 24th, 2018 lows anytime soon. Not in the next 6 months. Stop being a bear, at least for now. And guys, you know how difficult this is for me. Like, I love being a bear because for the purpose of trading weekly options, I love the fact that stocks drop much faster than they climb. So generally, when we're targeting a time frame, because stocks drop much faster than they climb, it makes perfect sense to utilize weekly options when the markets are going lower. Bull markets, I'll give you a little secret. In sideways market or sideways to higher market, kind of like what we have right now, it looks like they're dropping, but they're really going sideways and they're grinding their way higher. It pays to be a bull rather than the bear. And this is what it means. Point number 6, do not buy out of the money options. Clearly, when the market's trending sideways to higher, you don't want to be buying puts out of the money. You don't want to be buying calls out of the money. In a downtrend in VIX environment, you want to avoid buying options out of the money, period, on either side of the equation. Okay, what you do want to do is buy in the money or near the money calls for best results. And number 8, give your options more time to appreciate in value, meaning expect smaller moves, but expect to grind higher. In other words, if we take 10 trading days expect that 3 days, the market, 4 days out of the 10, the market could initially actually open lower, but ultimately it's going to move its way higher. Don't expect these huge moves like we've seen in the last few months. So expect smaller moves, and we're expecting smaller moves with calls because generally markets go higher much slower than they drop. Then maybe instead of buying weekly options to preserve capital and do better, you may want to consider longer term options like 2 weeks, 3 weeks, a month, and so on. So do not day trade. You're better off swing trading and holding your positions to give your options to appreciate in value. So because sideways trend will not produce good results in trading directional options from the context of day trading. So if you're day trading, this is going to be a very challenging environment. If you're trading options, now stocks is different, but we're talking about short-term options like weekly options here, okay? Stay away from day trading because it will drive you nuts. The moment you're going to get into some gains, those gains are going to be wiped out. Why? Because, well, the market, as we had yesterday, was a crazy move. We assigned a specific numerical value in that move in our 13 markets move formula, and I sent it out to our alert subscribers and said, look, guys, this is a move 5. You don't want to day trade. We had some difficulties yesterday because the market, just kept going higher, 5 points higher, 5 points lower, and so on. And so generally you want to avoid certain days like this because they're going to be your lower probability days. So if you're not familiar with the 13 markets move, guys, click the link below. Get information, take the course. It'll definitely make your life easy as a day trader or a swing trader. Guys, thanks for watching. I will catch you in the next video. Great success to you in 2019.